Chapter 17, Investment and Business Brokerage. In this chapter, we're going to talk about business sales and uh, we're going to talk about investing in real estate and we're going to talk about some investor lingo so that you could learn some of the terminology that investors use. Well, we'll get into it. So in this chapter, we're going to explain the advantages and disadvantages of investing in real estate as the investment vehicle. Then we're going to describe the tax benefits of real estate investments and the effects of the New Jersey Uniform Commercial Code. So, what are the advantages of investing in real estate? Well, what are the advantages in investing in anything really is to generate a return, some sort of a return on your investment, right? Leverage. What is leverage? It is using someone else's money. It's using borrowed money. And then hopefully, by the time you sell whatever it is that you bought, it would increase in value enough that you'll be able to pay it all back. And inflation as a hedge. You could use inflation as a hedge. What does that mean? Well, property values go up with the market simply by holding on to the property because property values fluctuate. Property values go up, they go down. So that's called inflation and using inflation as a hedge. If property values are going up and you've done nothing to your property, it's just that how the property values are flowing. Well, that inflation of the values can benefit you as well. You buy low, sell high, right? You don't buy high, and then when the property values go low, panic and sell. That's a quick way to lose all your money. Some of the disadvantages of investing in real estate is real estate's not a highly liquid investment, meaning that you can't buy it today and sell it today and expect to make money. You're probably going to lose money. You buy it today, you sell it tomorrow, you'll probably still lose money. You got to do something for the real estate in order to gain value. I mean, inflation takes time with real estate. Real estate's not like stock market where you could buy it now and then in an hour the price is radically changed. Real estate doesn't work like that. It's a lot slower. So it's not highly liquid over the short period of time like stocks and bonds may be. It does require legal and expert legal and tax information, and it is a high level of risk involved if you don't know what the hell you're doing, because it is a very expensive amount of money that you're investing in there. All right, so let's do the highlights on this. Okay, so this first sentence is on the first page, 327. And the next sentence is continued on the next page where we talk about the leverage. It continues on to the next page. Everybody got that?
Got it.
Yes.
All right, remember, you got to tell me. Otherwise, I'm here just staring at you trying to figure out if you're done or not. All right. So the ways real estate investment can yield return. Well, you could hold on to the property and use inflation as a hedge as property appreciates in value due to that inflation. And then you sell it at a higher price. Or you hold on to it and you rent it out and you generate income by the rental. And then cash flow, well, that's spendable income after all your expenses, all the rental income that comes in after your expenses on the property. Cash flow is your spendable income. Pyramiding through refinancing is when you keep refinancing property as you gain equity in it. You keep refinancing the property and pulling the equity out and then investing it in other properties, using it as a down payment to buy another property. So all of your assets, all your property assets, they're highly mortgaged. Okay, that's what pyramiding through refinancing is. There's nothing wrong with it as long as you make your payments and all, but just keep in mind you keep doing this. You could find yourself owning millions of dollars of property in a short period of time. However, it is all highly mortgaged. At some point, you should start paying it down to keep some of that equity, you know? So what is equity? Equity is the difference between the market value of the property and what's owed on it. You could build equity in three ways: by making mortgage payments and paying down the property's debt, by doing improvements to force the value of the property to go up, or just by inflation. As property values fluctuate, you build equity. So let's highlight cash flow is spendable income. The object of owning income property is to generate income, spendable income. You want that cash flowing, right? This is on the bottom last paragraph, page 328.
Got it.
All right. So let's talk about some of the tax breaks for home sellers. Well, we know if it's your primary residence, we've already learned about this in chapter 8, the tax chapter, that if you're selling your primary residence, you could benefit from capital gains tax exclusions from the profit of any primary residence that you sell if you lived in it for 2 out of the last 5 years. Single filers are entitled to up to a $250,000 capital gains tax exclusion, and married couples who file their taxes together jointly can get up to a $500,000 capital gains tax exclusion from the profit of any sale of their primary residence that they lived in at least 2 out of the last 5 years. And if you have to sell it before then, the IRS may still allow you to take a capital gains tax exclusion if you are forced to sell due to a hardship, which the IRS describes as you being forced to sell the home early because of a job loss or job transfer, or for health reasons, or death, divorce, or multiple births. Then you could still take advantage of those capital gains tax exclusions. And you can use this deduction as often as every 2 years. So sellers must pay income taxes on the profit from the sale of any investment property, but not their primary residence. The one you're living in is your primary residence. You could only have one primary residence at a time. You can only live primarily in one property at a time. So if you have more than one property, you can't write them all off on your taxes when you sell them. All right. So that's on exams for sure. 1031 exchange. If you're selling an income property, an investment property that you have to pay capital gains tax from any profit on the sale of an investment property. However, if you know about the Section 1031 of the IRS tax code allows an investor to sell their investment property and purchase another like-kind investment property. If they do this within certain time frames and they notify the IRS that they're doing this, you can defer any income tax that you'd have to pay on this property until you eventually sell that new property that you bought and then realize the gain by cashing it out. So next to exchanges, write the number 1031, because this is 1031 of the IRS tax code. And it's a real estate investor can defer taxation of capital gains, that's the profit on the sale, by a like-kind property exchange. You don't need to find another property that's owned by somebody else that you're going to be purchasing and then exchange properties with them. That would be like next to impossible to do. So instead, the IRS allows you to sell your property and then look for another investment property that's similar, and then purchase that property. So you reinvest all the money from the sale from the one property into the other one, and then you don't pay any income tax. Okay? Because you didn't realize the gain, you didn't cash it out, you're not spending that money. You reinvested it all in another investment property. Any money that you do cash out, though, that's a capital gain, and you do have to pay taxes on it. So the Section 1031 allows, also known as a like-kind exchange, allows an investor to sell one investment property and buy another one outright. The investor must identify the intended purchase within 45 days of selling the first parcel and then complete that purchase within 180 days. Now, don't misinterpret this as 45 days plus 180 days. That 180 days includes that 45 days time frame to identify the property, then notify the IRS that you identified the property and what that property is. So you need to be in constant communication with the IRS along the stages. This is why you should put together a team of people. You got the investor that hires the real estate agent that's familiar with 1031 exchanges and has an attorney or tax accountant who communicates with the IRS. And then when the property being bought, the replacement property costs less than the one being sold, the difference in property value, the difference in price is known as boot. And boot is loot, and all loot is taxable. It's a capital gain. So you guys have these highlights?
Got it.
So now we'll move to my slide that explains all that same stuff, just the way that I spoke it. All right, so 1031 exchange allows an investor to defer paying income taxes on the profit of the sale of an investment property if they reinvest it in another similar like-kind investment property. They wouldn't have to pay income taxes until they eventually cash out and realize the gain when they sell it. Strict timelines must be followed to qualify for the tax deferment. Strict timelines must be adhered to, otherwise the investor will lose the tax deferment and must pay capital gains taxes on the sold investment property. So it's very important. We need to realize as real estate agents, it's very important to stay by these strict IRS time frames. So we should get a tax attorney or CPA to do the communication with the IRS. And we must notify the IRS that the seller is doing an exchange at the time they do the sale. Otherwise, they're going to have to pay for those capital gains taxes. They're going to have to pay taxes on that capital gain. The IRS would give the investor 45 days to look for another investment property and find one and notify the IRS we found the property that we're going to buy as an investment property, and then close on it within 180 days. It's not 45 plus 180. It's the total time frame has to be within 180 days. It's just within the first 45 days they need to identify the property. So boot is when the replacement property costs less than the sold investment property. The difference in value is known as boot. And boot is loot, and all loot is taxable. It's the capital gain that you pay the taxes on. Anybody want to take a snapshot of this one versus the highlights from here? It's up to you.
Got it.
Okay. So capital gain, once again, is the taxable profit on the investment. The basis is like the base price that it's the investor's initial cost for the investment. In this case, that investment would be real estate. So this is your basic investor lingo. The basis is the cost of your investment, your initial investment. Now, if you got to put more money into that investment to fix it up, you add that cost onto the base price, and this is known as the adjusted basis. It's all the money you have into the property, basically. So capital gain is taxable profit on the investment. Highlight that. And then highlight a basis of a property is the investor's initial cost for the real estate. They don't have a good definition here for an adjusted basis. My definition is probably better here. It's straightforward. It tells you it's the basis plus any additional money you put into the property. So it's the basis plus improvements minus claimed depreciation. It's the difference between the adjusted basis of the property, all the money you have in it, and its selling price. And then you only pay taxes on that. Here's an example of boot and the basis and adjusted basis on one slide with little financial figures here. So if you have a basis of $300,000, that's your initial cost to buy the real estate. And then you had to dump another 100 grand into it for improvements. You're all in $400,000 on this property. That's the adjusted basis. Got a better understanding of that now? Now, if you just sell that $400,000 property for $600,000, the current price of the property, the value, well, that means it appreciated $200,000, right? So if the property appreciates and sells for $600,000, there's a $200,000 taxable capital gain. If you were to reinvest it all in another income property, you would defer paying any tax on that if you did a 1031 exchange. However, if you were just to put that 200 grand in your pocket, it's taxable. You got to pay taxes on that 200 grand because that's your capital gain. Now, if you sell that property and you get the $600,000 and you reinvest it in another investment property which costs less, it's only $500,000. There's a $100,000 difference there. That's boot. And boot is loot, like cash. And all loot is taxable. That's your capital gain. $100,000 is your boot, like the pirate's booty, right? The pirate got the booty. So $500,000 would be the replacement property's cost. The difference in value is 100 grand. You're cashing out that 100 grand now, so you only pay taxes on that 100 grand, the realized gain that you're putting in your pocket at this time. Everybody understand that concept?
Yes.
Everybody? Y'all good on that?
Yes.
All right. Now, depreciation, we learned, is a loss of value due to any cause or condition. In this chapter, though, we're learning about depreciation as an accounting concept. Okay, so it allows the investor to deduct the cost of your investment and any improvements on that investment for taxation purposes. It has no reflection on the actual value of the property. This is just a mathematical formula when doing your investment for taxes. So it's not a reflection of the actual loss of the value of the property. It's used to reduce taxable income before your taxes are computed. Like you guys are here learning a new trade. I told you that this class is tax deductible. Your exams are tax deductible. Your fingerprinting, the licensing fee, any websites or tools or MLS memberships or what have you, that's all tax deductible. They're business expenses of a self-employed person, right? Well, an investor could invest in real estate. The cost that they bought that real estate for is tax deductible. It's an investment, it's a business investment. However, large purchases that business owners do or investors do, you cannot deduct them entirely in 1 year. Different assets you could deduct over a period of time. Like if you got a plumber who buys a van, they need a new van to carry all their tools in, they can't deduct the cost of that van entirely in 1 year. I believe with the IRS, it's 7 years that they could depreciate the value of that asset. With real estate, it depends if it's commercial or residential real estate. Residential real estate can be deducted over a period of 27 and a half years, and commercial real estate, 39 years. We're going to do a math problem. I'll show you how that's done. It's not hard. But before we get to that, a property's value cannot be depreciated or deducted all at once, like I just said. The asset has to be depreciated over a period of years, whatever its life expectancy is as defined by the IRS. Now, the value of the land cannot be deducted because land does not depreciate. So you can only deduct the value of the improvement, and that's important to understand. When we're doing these problems, it's referred to as an economic lifespan of an improvement. So let's highlight the title and this sentence, and let's write next to the title, economic lifespan of an improvement. Because anytime you hear about the economic lifespan or the economic lifespan of an improvement, because remember, you could only deduct the improvements value, not the land. They're talking about this accounting concept. I gave you a question here that's similar to one you'll get on exams that says if a property's estimated value is $500,000 and the land is estimated at $150,000, how much would be depreciated over 3 years if the asset has an economic lifespan of 27 and a half years? That's why I said right down here next to depreciation, economic lifespan of an improvement, so you know that this is what they're talking about. So here's a problem. And I don't know why it just triggers like that so quick. I don't know what I did to this slide to hate me like that, but I click on it and it goes through everything really quick. So if a property's estimated value is 500,000 and the land is estimated at 150,000, how much would be depreciated over 3 years if the asset has an economic lifespan of 27 and a half years? Well, you take the total property value, 500,000, and you got to subtract the land value from it because land cannot be depreciated. And then you're left with the improvements value of 350,000. This is why you get a tax bill. And when they give you the tax bill every year, they give you the total value and the land value and the improvement value. Okay? So you could only depreciate the improvements value. So you got to subtract the land value from the total value to get the improvement value. And then you divide that by 27.5 years. So what kind of property is this?
Residential.
It's residential because commercial property is 39 years. So then the answer is 12,727 and 27 cents. But that's per year. The question asked how much can be depreciated over 3 years. So just multiply that by 3. And the answer is 38,181 and 82 cents. Okay. Be careful on exam because this one answer for the 12,727.27, that could be one of the answer options. And you could get it and stop right there because you think you got it. Just reread that sentence. They're asking you how much it would be depreciated over 3 years. So you multiply it by 3. Okay. You want to snap a picture of how to do this math problem? Go for it.
Got it. Got it.
Got it.
All right, so the federal tax law limits the deductibility of losses from rental property. The first $25,000 of loss can be used to offset income from any source. Investor has to actively participate in the management of the property, though. We call that sweat equity. And it has to have income of less than $100,000 before the deduction is made. Tax credit is a direct reduction in taxes due rather than a deduction from income before tax is computed. I just showed you how to do how to deduct the value of an investment property from the taxable income before you compute your income taxes. That's different than a tax credit. Tax credit is more valuable. A tax credit is a dollar per dollar matching amount. So they show you here, tax credit, therefore, is a far greater value. Now, if you have older properties, you can offset some of the investments to some of the money to improve that property that may need work. Tax credits have been provided for taxpayers who renovate historic properties that are designated by the Department of the Interior and listed in the National Register as a historic landmark. A property of historical significance located in a state-certified historic district, the allowable credit is 20% of the money spent on any renovations. Now, the work must be accomplished in accordance with the Federal Historic Property Guidelines and certified by the Department of Interior. After renovation, the property must be used as a place of business or rented if it cannot be used as the personal residence of the person taking the tax credit. There is a credit of 10% for rehabilitation of non-historic buildings placed in service before 1936. Those non-historic buildings must be non-residential property. The law also provides tax credits ranging from 4% to 9% each year over a 10-year period for expenditures on new construction or renovation of certain low-income housing. So tax credits can be used for a lot of things. Even our politicians offer them when they screw up. Here's an example. When we had the mortgage market meltdown in 2006, it started really getting bad in 2008. That's when the politicians just started to realize it. But we in the property business realized it as of 2006, that it was peaked and started dropping the property values. But the politicians, in all their arrogance, they're the ones that actually created this bubble burst by forcing the banks to offer more loans, to lower their lending standards, to offer more loans to poor people, and then target minority groups as well. So when when property started defaulting and they lowered the standards, which raised the property prices and caused inflation to the point that people were defaulting on these loans. This was offered to anyone who rushed out to buy a home during this time frame. The politicians, in all their arrogance, figured, well, we gotta stop the property values from dropping. So they figured that they had control over that, when really the market was just correcting itself. The property values were getting inflated, going up and up and up. Eventually, that bubble burst, and the values got to correct themselves and come down. So politicians figured they had the answers to it. They said, you know what we got to do? We got to get people to rush out and buy a home. If we can get people to rush out and buy a home, that'll stop the property values from dropping, right? Supply and demand, right? If people are getting out there and buying homes, well, then that'll keep the values high. So they offered it in 2008 was the first time they offered it. It was like mid 2008 to mid 2009. They offered a $7,500 tax credit for any home buyer who rushed out there to buy a home. And it kind of flattened the curve a little bit until the end of that offering, and then property values continued to drop. So all they managed to do is get a bunch of people to rush out and buy a home during that period, thinking that we got to be near the bottom of the bubble, and that $7,500 should be enough buffer to, to make up for that difference if the values go down a little bit more. Unfortunately, it was not. And property values continued to drop like a brick. And then those people who rushed out to buy a house, some of them, just like stock market purchases, they panicked and they said, oh, I got to sell. I'm underwater. The house ain't even worth what I paid for it anymore. So then they're starting to do short sales to get out of the property. Now, the one thing is the IRS put a penalty in there. You had to hold on to that property for at least 3 years. If you didn't live in it for at least 3 years, you had to pay all that money back from that tax credit. So politicians incentivized people to rush out and buy a home. They gave them $7,500 tax credit if they did, but they had to live in it for 3 years. Otherwise, they got to pay all that money back to the IRS. And if they didn't pay it back right away, they faced taxes and penalties. So basically, all politicians managed to do is pull more people into financial hardship who previously didn't have issues. And then people are like, what are you doing? And politicians were like, well, we were on the right track. We had the right answer. The problem was we didn't throw enough money at it. That really was their panic problem. So they offered another tax credit for another year from mid-2009 to 2010. This time they're offering an $11,000 tax credit because they figured they didn't throw enough money at the problem to incentivize enough people to rush out and buy the properties to try to stop the property values from correcting themselves, from dropping like a brick. So a bunch more people rushed out after that. They were like, yeah, this got to be near the end of the bubble bursting. So people rushed out and they bought homes. A lot more people did now. And so that curve almost completely flattened, almost. And politicians are just like, see, it's working. And then the end of the year, when that tax credit went away, property values continued to correct themselves again. So did politicians really have the answer, or did they really stretch out how long it took for that bubble to burst? That's all they managed to do was string it out and make it last longer instead of ripping the Band-Aid off and letting people lose homes who were going to lose their homes. Instead, they just stretched it out longer and pulled more people into financial hardships. And that's actually what happened there when they offered those 2 tax credits. Because now when those people then did short sales, now they had to pay $11,000 back, and if they didn't live in it for 3 years. And this is something that really happened. Any of you ended up watching that movie, The Big Short, yet or no? That explains what happened during that time frame. Okay, so let me paint the picture for you and show you the math of it, how a tax credit is more valuable than a tax deduction. In this example, we're going to compare a $15,000 tax deduction versus a $15,000 tax credit. So tax credit is a direct reduction in taxes due rather than calculating a deduction from income tax before it's computed. In this case, we're going to compare somebody who has an income of $100,000 and a $15,000 tax deduction. So you have $100,000 income, then you subtract the $15,000 tax deduction, and you have $85,000 left over of income. If you're in a 15% tax bracket, you multiply that by 15%, and you have $12,750 in taxable income that are taxes due. So you owe now $12,750 in taxes, income tax. Now, if you get a tax credit, you got that same $100,000 in income. However, you calculate your taxes first. If you're in that 15% tax bracket, you base it off of the $100,000 income. That's $15,000 in income taxes owed. But now you subtract your $15,000 tax credit, and now you owe nothing. Which one's more valuable? Calculating the tax credit is significantly more valuable, right? Provided you don't got to pay it back because a politician offered it as an incentive for something, right? So this is just a side-by-side that really makes it pop, and you could really see the difference right here. So tax credit's way more valuable than a tax deduction. All right. Land contracts, we already discussed those in Chapter 11, right? And I think we discussed them another time too, but what is a land contract? Also known as a installment sales contract. It's basically seller financing, a type of seller financing on the property, right? Where you make installment sales and you wait for the deed once you paid off the full amount or some prearranged amount owed. All right, and let me see. Income tax calculations are figured on the investor's marginal tax rate, the rate which the top dollar is taxed. All right. Real estate investment syndicate. A syndicate, we've learned about these syndicates once before, I believe we discussed them. It's not a legally formed business entity. It's carried out, you carry out a business project. When the project is done, the business entity is dissolved. You don't have to register it with the government or anything like an LLC or a S Corp or a corporation. It's two or more people coming together to carry out a business project. When the project's done, the syndicate's done. A joint venture is very similar. It's not a legally formed business entity. It's just joining together of two or more groups. And when the project is done, that joint venture is done. Real estate investment syndicate is a business venture in which a group of people pool their resources to own and maybe even develop a particular piece of property as an investment. You know, like the bunch of little old ladies around the table, they pool their funds together to buy an investment property. You know, that's it. Okay, so here's a warning for us as real estate agents. When seeking money from investors to invest in a real estate project that you own, offering a percentage of the profit to the investors, use caution, beware. because real estate agents, you see this all the time, that real estate agents, they help all these other people who got money to help them locate these investment properties and how they fix them and flip them and hold on to them and just fix them up and rent them out. And you get this idea now that, wow, I could spot a good, I would have never thought that property would have been a good investment until I seen what they did. So you start working with all these investors, and after a while, you could spot a good investment property from a mile away. Now this light bulb goes off in your head, and you're like, I got an idea. How about I buy the property? I wish I had the money. Oh, how can I come up with the money? I got an idea. I'm going to put out an ad out there to try to get investors to invest in a project, my project, that I'm going to own. But I'll share a portion of that profit with them. Now, if you get this idea in your head to do this, you got to beware, because this could be classified as a security. And securities are highly regulated by the SEC and the state of New Jersey. We got blue sky laws. But we got to be careful that we have proper licensing to do this. And if you're not licensed to deal in securities, as long as you get someone who is, and you have them on board in your team, because you need somebody, because it's real estate. So we need to have our real estate license, and we need to have somebody who has a securities license. And then they could do whatever's required to register that property as a security, create the prospectus and disclose that to all possible investors who are not familiar with real estate as the investment vehicle. Because if we just collected money from people and to invest in our project, and we just did this on our own, and they invest with us, and they're not familiar with real estate as the investment vehicle, and then they, God forbid, lose money, you're going to jail. Okay. You can't do that. You could do it if you have proper licensing and registering and disclosing of a prospectus of all the possible risks, not just selling them on the upsides on how they can make money on investing in your project, but what are the risks involved? What if there was some war in a third world country that affected our real estate project here? Or what if there was some social group that has an agenda for something, and they decided that they want to burn this property to the ground because, hey, they got some kind of misguided social justice agenda on their minds, and our property went up in smoke now. Now we're screwed. All right, so you really got to be careful when seeking other people's money for an investment property that you're going to own, but you're going to share the profits with them. We went over general partnerships and limited partnerships in an earlier chapter, 5 or 6 it was, right? Where we're talking about business ownerships, businesses. A general partnership, all of the partners are general partners that work in the day-to-day business and can be held liable for any additional debts the business takes on. In a limited partnership, there's at least one general partner, and all the other investors are limited in their liability, that all they can lose is their initial investment in the business, and they can't be held liable for any additional debts that the business takes on, for any additional loans and whatnot. Just a little recap there. All right, a REIT is a real estate investment trust, and investors can get the same tax advantages as mutual fund investors. In order to create that REIT, you got to have at least 100 investors, and at least 75% of that trust income has to come from real estate as the investment vehicle. So where are we here? Page 333. You guys have this highlighted, and you got these notes here? See chapter 7,
Yes.
1-4, okay. All right, now, do you need to have a real estate license to sell a business? No, unless real estate's involved. Then we need a real estate license to market that business for sale. Now, to put a contract together for that business, you need an attorney involved. also for the property, because we cannot prepare sales contracts for commercial real estate. We can market it, find buyers, but we cannot prepare the contracts for it. So a lease or real estate sales contract needs to be transferred, negotiated, or prepared by an attorney. You don't need to have a real estate license to sell a business unless real estate's involved. Besides title to the real estate or a present lease, an attorney would be needed to prepare the sales or lease contract and the contract to transfer other business assets, the chattel, like trade fixtures, the stock and inventory, the business name, customer lists, goodwill, any special rights such as copyrights, patents, franchises, licenses, ticket lottery machine licenses, etc. So let's highlight here, a person who sells or negotiates the sale of a business for others for a fee is required to be licensed as a real estate broker. The exception is when business is sold without any real estate interest in any form. I hate the way this book words things. It always words them backwards. In other words, do you need to have a license to sell a business? No. See, the book backs into it and says that you do, unless there's no real estate involved. So I say you don't need a license to sell a business, which is true. Unless real estate's involved, then you do. All right. Financing the sale, the purchase of a business, well, you're going to need to have a lot of money to put down. Substantial down payment and seller providing purchase money mortgage for the balance of the selling price of the real estate. The business purchase requires cash or personal loans to purchase it. So this is what we need to know for exams, plural. The Bulk Transfer Act is designed to protect the seller's creditors from the fraud perpetrated by a business owner who sells a business, including the equipment and stock, and then disappears, leaving creditors unpaid. That's on page 334. You needs to know it for the exam. So just imagine, if you will, you're helping somebody sell their business, and you say, so what's included with the sale of this business? Is all the inventory included? Are the tools and other stuff included as well? And they're like, yeah, everything's included in the sale. You really should ask another question. Do you own it? Are you leasing the tools? Are you making payments on them, or do you own them outright? Is there any balance owed on that or the inventory? Because if there is, we need to make a list of all outstanding debts to creditors and make any potential buyers to this business aware of it. And then also notify those creditors that the business is for sale. If you fail to do this, and that person sells the business and then leaves those creditors unpaid, you help them commit fraud. And you help them commit a crime. But you didn't get any profit out of that. You just got your commission. But you help them perpetrate a crime. And therefore, you could be held liable criminally. Criminally, not just financially. So, when putting a business up for sale, can you sell a business? Sure. I would make sure an attorney's involved, to make sure that attorney gets all the ducks in a row, to make sure that if there's any debts or stuff that has not been paid for, that they sign off on it, to clear you, that all the checks, T's have been crossed and the I's have been dotted, to make sure that you don't get accused of committing that crime, okay, by assisting a seller perpetrate it. All right, so the Bulk Transfer Act is designed to protect the interests of the buyers as well as those of the seller's creditors in the sale of the business. Now, I put a note here in plain language that the Bulk Transfer Act is designed to protect a business seller's creditors in the sale of a business. It also protects the buyer, though, but as a side effect. The main intent of this law is to protect the seller's creditors so that the business seller doesn't sell the business without paying back the creditors what is owed to them, and they just leave them unpaid, committing that fraud. So here's a slide that I put together with all of that information in one spot. If you want to snap a picture of it, do so. You do need to know the Bulk Transfer Act, specifically Article 6, but you don't need to know that. Article 6 is the Bulk Transfer Act. The Uniform Commercial Code, the UCC, we learned about a UCC, that is the Uniform Construction Code, that deals with the minimum standard for construction. This is a different UCC. It's the Uniform Commercial Code, which regulates the sale of businesses. The portion we need to worry about is the Bulk Transfer Act that regulates the transfer of chattel. What is chattel? Tangible personal property when selling a business. It prevents fraud when the business is sold. Prevents the seller from selling the business and leaving the creditors unpaid. We need to get that list of all the unpaid creditors and then make sure that they get paid. Provide a list of those creditors to the buyers, and then contact the creditors, let them know the business is for sale. All right. And that concludes this chapter. Let's do the key terms to review, and we're done for the day. Yay, look how quick that went. So, cost plus improvements minus depreciation in key terms 1. Cost plus improvements minus depreciation.
Adjusted wages.
Yes, the adjusted basis. 1 is A. An increase in value.
Appreciation.
I'm sorry?
Appreciation.
Yes, 2 is B, appreciation. Initial cost of real estate.
Basis.
3 is C. You're starting to see a little pattern here. They forgot to mix up the answer options in this set of key terms. A document transferring ownership of personal property.
Bill of sale.
Bill of sale, 4 is D. Extra money or property received by one party in an exchange.
Boot.
Boot, 5 is E. A law regulating the sale and financing of business personal property.
Bulk Transfer Act.
Transfer.
6 is F, the Bulk Transfer Act. A taxable profit on the difference between adjusted basis and the net selling price of an asset. They're in order.
Capital gain.
A capital gain, 7 is G. Money left from rental income after expenses are paid.
Cash flow.
Cash flow.
8 is H, cash flow. Yearly bookkeeping charge for part of the initial cost. This is a horrible definition for it, so 9 is I. I'll just tell you that outright, even though you know what it is because it's in order. That's a horrible definition there, no. Tax deferred mutual transfers of income property. Exchange, 10 is J. To be more specific, the 1031 exchange, right? Real estate held for rental income.
Income property.
11 is K. All right. Now let's do the key terms 2. This one is scrambled up. Law regulating transfer of business personal property. Well, we kind of just did that, didn't we?
Uniform Commerce.
10 is A, the Uniform Commercial Code, the UCC. Refinancing property to buy more.
Pyramiding.
That's pyramiding. 4 is B. Direct deduction from income tax due.
Tax credit.
9 is C. Joining together of 2 or more people to carry out a business project.
Syndicate.
8
Syndicate.
is D, the syndicate. A group pooling resources to buy real estate. Like all those
Real
little
estate
guineas.
syndicate.
Yep, the real estate investment syndicate. 5 is E. A rate at which the investor's top dollars taxed.
Leverage. No.
What do we call the rate at which the
Marginal
investor's
tax
top
rate.
dollars taxed? It's the marginal tax rate. 3 is F. Sale in which the seller receives purchase price over a period of years.
Real estate investment trust.
Return.
A sale in which the seller receives the purchase price over a period of years.
Or return.
Installment sale.
Return.
Installment sale. 1 is G. Extensive use of borrowed money for purchases.
Leverage.
Leverage. 2 is H. A fund making real estate investments and selling shares.
Real estate investment trust.
It's a REIT, a real estate investment trust. 6 is I. Cash flow plus income tax savings plus appreciation. These are all examples of
Return.
a return. 7 is J. And that concludes chapter 17.